Each day in the newspaper, you'll read a story about a company that's had a restatement, a major failing of the executive leadership in providing truthful reporting. And the media will often ask the question, where were the auditors? How could this happen? And so we sometimes wonder, does these types of failures mean auditing is not working? Are auditors failing to satisfy their professional requirement? Or is there an actual acceptable rate of audit failure? And the phrase reasonable assurance, you'll notice, is prominent in the auditor's report because the auditors know that they cannot look at everything. The auditors know that they cannot provide complete or absolute assurance. And so they've actually developed a model called the audit risk model to help predict how successful they are. And the audit risk model is designed to help plan the audit, to help provide assurance that sufficient appropriate evidence is gathered, to basically provide a map for the auditors. So let's dig into what that model looks like. The audit risk, and so we're going to take this in several different parts. Audit risk equals inherent risk times control risk times detection risk. We talk about inherent risk and control risk collectively as the risk of material misstatements. In essence, before the auditor begins their work, before the auditor does a single thing, what is the likelihood that financial statements contain material misstatements? Reality is, we don't know for certain what these are. These are going to be assessed. The auditors are going to look at evidence and go, my best guess is this. If we were certain there was a misstatement, that would equal 1. But the truth is, most clients probably don't have a misstatement. And our job is to identify the ones that do. And so we'll design an audit so that we have sufficiently low audit risk. But what is audit risk? Audit risk is the likelihood the auditor says there are no problems when in fact there are. Well, two things need to happen for the auditor to say there are problems when there are. There have to be problems, which is captured by the risk of material misstatements, and the auditor has to fail to detect them, which is captured by detection risk. And so we're going to be digging deeply into those. But I want you to notice there are two reasons why the auditor could fail. The first, and it's directly behind me, is called sampling risk. The auditor gets unlucky. We know when we look at samples, there's a statistical probability that we're wrong. That's why when you see polls, it's 57% of the population believes something plus or minus 3% or 4%. Well, that's sampling risk. If we were trying to reach a conclusion, we would only be able to say 95% of the time. But if I was to even say it's below 57%, well, there's a chance that it's in that +3. And so the sampling risk is unavoidable. We can do things to minimize it, but not eliminate it as long as we do samples. Now, non-sampling risk is a different beast. This is where the auditor makes an avoidable mistake. For example, if the auditor picked the wrong audit procedure, they can't deal with that. That can't be eliminated. But there's no reason why the auditor has to pick the wrong audit procedure. That's why we have a review process, this. But these types of errors cannot be eliminated. The possibility of them cannot be eliminated. We could fail to detect and using the appropriate procedure. In other words, we pick the right procedure, we just don't find the error. So we correctly identify we need to do inquiry of the CFO, but we somehow don't appreciate what he's saying or she is saying. The third possibility is we ask the CFO the right questions, they tell us the answers, but we don't understand what they mean. And so we misinterpret what they mean. And so wrong procedure, right procedure, applied wrong, or right procedure, applied correctly, and the output wrong. There's no reason why an auditor has to make any of these errors, but the auditor cannot guarantee that they haven't made any of these errors. So there's always some non-sampling risk. And so if we were to dig deeper into the individual components, the total possible misstatements that could occur, some are going to be caught by internal controls, some are going to be caught by the auditor, and whatever remains is an undetected material misstatement. And so inherent risk is that susceptibility and an assertion. You'll notice we're immediately linking audit risk back to assertions, that compounding effect. So if you didn't understand assertions, it's going to continue to haunt you. And so inherent risk will relate to an account and an assertion. Control risk is the likelihood the controls fail. And so detection risk is the likelihood the auditor fails. So why is there inherent risk? Or what would be the factors that you would look at? The nature of the client's business, what we learned in prior audit engagements. So let's deal with those two first. Certain clients are engaged in riskier business. For example, a brick and mortar retail store seems to have less risk than a company that does both brick and mortar and online. There's a second channel of business, so there's a second possible error, type of error that could occur, a second method of problems that could occur. Results of previous audits. If we learn something from prior audit engagements, for example, the management is very aggressive in their reporting practices, that the complexity of the audit, we wouldn't discard that. If we found that there was a lot of misstatements in the last audit, my assumption would be there's probably going to be a lot of misstatements as I start this audit. So I want to be using that information when I'm planning the audit. Now note, when I've talked about these, I haven't been talking about misstatements as intentional or unintentional, error or fraud. I've been using the more generic term misstatements because our responsibility when assessing inherent risk is to consider both the possibility of an intentional or an unintentional audit. We'll also see initial versus repeat engagements. When it's your first time on a client, inherent risk is higher because we don't know. We don't have that information to assess. Repeat engagements, we know about more about the client, we know more about their systems, we generally can gather comfort and we can set inherent risk lower. When we don't have information, the auditor being conservative, not wanting to assess risk too low, is biased towards setting it too high. Related parties are more complex because they require more disclosures. Essentially, whenever you see anything in an audit that increases complexity, it's going to impact inherent risk. So you'll see this come up in the way questions are phrased. You discover the client has a number of related party transactions. How is it going to affect your assessment of inherent risk? Well, it's going to increase it. Non-routine transactions, again, are a red flag. They're going to draw your attention. They're going to require things that require judgment. And so not auditor judgment, but management judgment. So if there are a lot of estimates, if there are a lot of subjective decision making, if there's timing decisions, if there's contracts that are complex, these are all judgment-based items. So makeup of the population. So the underlying transactions, what are they like? Are there more of them, less of them? So we're going to look at those factors. And so we'll also see the phrase fraud triangle brought into this type of assessment. If the client has a lot of incentives to do untruthful reporting, you're going to see a lot of concern over inherent risk. Now, opportunities, so if you recall the fraud triangles, incentives, opportunities, and rationalization. Incentives are going to relate a lot to the inherent risk, but opportunities and rationalization are going to relate to control risk. So what is our responsibility for control risk? Well, we have two real responsibilities. This is where we're going to go in and understand controls. So we're going to talk a lot about controls. We have a whole section on internal controls, but our control risk assessment is essentially two parts. First, we've got to understand internal controls. If we are going to set control risk below maximum, then we have to get evidence to support this. Note, within inherent risk, there was only we need to assess. So we're going to do some risk assessment procedures, but we're not going to need to test our assessment because that's the rest of the audit, essentially. But internal controls, if it's a private company, there is no obligation to do further testing if we conclude they're likely to be ineffective or it would not be cost effective to test them. Now, detection risk, as we previously discussed, is going to exist for a couple different reasons. Sampling risk exists because the auditor is not going to look at everything. But also, the non-sampling risk exists for a couple of reasons. I gave you some more details here than I did on the prior slide. So if you're struggling to understand, we're going to say this again. If you pick an ineffective procedure, so i.e. you lack the knowledge, training, or there's inadequate supervision, that procedure will not meet the definition of an effective procedure. When you don't pick an effective procedure, you're likely to not gather appropriate evidence. When you don't gather appropriate evidence, you're more likely to miss something. Now, it's possible we identify the correct procedure, but we apply it wrong. Maybe we did lack the training, we were just sloppy, indifferent, we weren't properly supervised. The personal indifference is you don't show due care. And so we're seeing that general standard notion of the auditor's got to be independent, they've got to be properly trained with proper competence and actually exercise that. And so this one relates to that due care. Now, incorrectly evaluate the results. That could be a bias, lack of independence, lack of knowledge. And so we start to see some symmetry emerging across the units. Why does audit fails, or why would the auditor fail? Because they haven't achieved the general standard, which says they're competent, independent, acting with due care. And so even though in the revised clarified standards, we don't use those terms as explicit, they are embedded in everything that the auditor would be acting with due care. The auditor would be acting with sufficient competence and training, and the auditor would have independence or lack of bias, or they would be we could use more popular term today, skepticism. The auditor did not use sufficient skepticism when evaluating the results. And so these will come out in different ways as we do problems. So we've talked about audit risk as a concept that it just exists outside of the audit. The auditor will set the audit risk before they begin, and then we'll look at who's looking at the financial statements. Public companies are going to generally have lower audit risk. Remember, lower audit risk means we need to do a more effective job. Likelihood of financial failure. Companies that are on the verge of bankruptcy, the public is relying more on the auditor to ensure proper disclosure, in particular certain types of disclosures. And if we think management's lying, we're more likely to do this. Essentially, all of these relate to another type of risk called engagement risk. That's the likelihood that the engagement will lead to financial losses for the auditor. And a big source of that is litigation risk. And so I know I've just shown two more risks at you. Audit risk relates to engagement risk, and engagement risk relates to the litigation risk. So if we're in bed with a client who's doing very aggressive procedures, they're known to lie, they're known to things, and we should reasonably know this, we can expect greater litigation risk. If we have greater litigation risk, then we have greater engagement risk, so the likelihood that our reputation as a firm or our finances will be damaged by associating with this client. So when we want to set engagement risk lower, we have, when engagement risk goes up, we set audit risk lower to protect ourselves from those additional risks. Now, the way the model works is pretty simple from a conceptual framework. We get to set our own audit risk. We have to assess inherent risk and control risk. That's the cards were dealt by the client. We don't have a lot of control over those. Now, detection risk we have complete control over. We know we want to achieve a certain audit risk. So what we do is we set inherent risk and control risk at such a level that we achieve that level. So we have two basic audit strategies you're going to see referenced. One's called a reliance strategy. Essentially, we're going to rely on the internal controls. We are going to put some weight on the controls, which means we're going to gather not all of our evidence from the detection risk. And so it's very common to set control risk below maximum because it allows us more flexibility where we gather evidence from. Now, we would first need to obtain an understanding of controls, believe they could be effective as designed and as implemented, and then we're going to need to test that those assumptions. If we don't find they're effective, either in design or operation, we are going to have to set control risk at maximum. And so we will, when we get to the internal control chapter, probe that much more deeply. But for now, just know, understand controls. And if we're going to assess below maximum, we're going to need evidence to support that. The alternative is called a substantive strategy. And that's where we assume the controls are not going to be effective. And so remember, this could be multiple strategies across an audit. So for some accounts, we may use a reliance strategy. For some, we may use the substantive strategy. So why would we use the substantive strategies? One, the controls aren't relevant for the assertions we're testing. They have controls that are just not relevant for the assertions we're testing, and therefore would be not an effective procedure. The second possibility, they have controls, they look good, but only on the surface. Maybe they're designed, but they're not in operation, or maybe they're not designed properly, but we don't think they're good enough. And so if we don't think they're going to be effective, we're not going to use them. Third possibility is cost benefit. We don't think it makes sense from a cost perspective to test them. If we can gather alternative evidence from other sources at a lower cost, then we wouldn't test them. Now, I'm not saying it's expensive to test. You would always look at the cost benefit. And that's why the word is inefficient and not costly. Something can be costly but give us compelling evidence. If that were the case, we would still engage in that procedure, but we would look at both the cost and the benefit. Now, the audit risk model is based on assumptions. Just because an auditor wants to achieve a 5% or 10% audit risk does not mean that it is possible. The client may be unable to provide us the evidence we need to get there. And so we have to look at that phrase, sufficient appropriate evidence. That's what the audit risk model is gathering to us. It is possible that the audit risk model, the math will not work, that we will never be able to formulate it, in which case the appropriate recourse is to not issue a standard opinion. And later on, we're going to talk about what you would do, the various options if you're not issuing a standard opinion. The other possibility is auditor error. The auditor could assess inherent risk wrong. The auditor could assess control risk wrong. The auditor could assess detection risk wrong, or determine, they don't really assess detection risk. The procedures they generate might not be appropriate given the other decisions they've made. So any type of auditor error is going to undermine the audit risk model. So how does detection risk relate to evidence? Well, detection risk is inversely related to audit evidence. If we try and lower the acceptable audit risk, then we are going to need to lower the detection risk. So if we said we wanted to do a more effective audit, we're going to try and lower the detection risk. The way we lower detection risk is by increasing the audit evidence. And so we want to be very methodical in our approach. And so we've got a figure to help us bring this all to form. Now, this figure is overwhelming. And I'm going to ask you to go through this on your own as well to try and understand this. I'm going to do a couple of them for you, but you should be able to explain all these because it's going to come up in different shapes. So we've already done acceptable audit risk and planned audit evidence. But what happens to inherent risk? If I told you inherent risk went up, in order to keep that formula in balance, we're going to have to reduce detection risk. When we reduce detection risk, we're going to have to increase our audit evidence. So inherent risk goes up, detection risk goes down, audit evidence goes up. So materiality is a little different. If we say we're going to design our audit to catch smaller and smaller errors, then we're going to need more and more evidence. So if your initial plan was to design the audit to catch $1 million errors, you would have a certain level of procedures. But if the senior or manager said, no, that's too high, we need to reduce that, you're obviously going to need more evidence. You're going to need to do more procedures. So what influences whether you achieved your desired level of audit risk? The accuracy of your inherent risk, and your accuracy of your control risk, and your evidence. If your evidence is good, you're going to have good evidence, a good outcome. So how can you reduce audit risk? You really can't reduce inherent risk. That's the card you're dealt. So we're going to look at that. Now, control risk we may have some influence over. We may have initially said that we're going to set control risk at maximum because we didn't think it was efficient. But we might have to come back and revisit that if it's necessary. In other words, if that cost-benefit decision framework changes, we may go back. We might also expand our sample size. So we know larger samples are generally going to give us better results. Likewise with detection risk, we could generate larger samples. Larger samples are more likely to be representative. If the underlying financial statements are free of material misstatements, more evidence should reveal that. We might also have to engage in additional audit procedures. And so those can take a variety of shapes and forms. We might do additional testing of particular accounts. We may do additional inquiry. We might look for more documentation. it depends on the real context, but these are always going to be in the context of a particular account and a particular assertion. We don't nebulously just do additional procedures. So just because we're having troubles getting below materiality for liabilities does not mean we would do more testing on receivables, because we need to verify individual accounts. And so we're going to look at a lot at that when we look at how you'd finish the audit. So as a young auditor, there's going to be two real mistakes you can make. You can set detection risk too high, or you can set it too low. If you set detection risk too high, that means there's too great a probability that we're going to fail to detect a material misstatement when present. So if we do that, we are ineffective. But if we do that, we're also very efficient, because we don't need a lot of evidence. And so the counter to that is setting it too low. If we set detection risk too low, we're going to gather a lot more evidence. That's going to make us very inefficient, but overly effective. And so the auditor is constantly going to be asking this question: how do I balance effective and efficient? Because as we started, we're a noble profession that is always failing publicly. And so how do we balance we need to be profitable and we need to be effective? And so setting control detection risk too low, well, in theory, minimizes the likelihood of failing. It will make us not profitable. There's no evidence clients are willing to pay for the certainty that it would take to set detection risk near zero. So how do we do it? And so we balance it. We balance effectiveness and efficiency through communications with the audit committee, the board of directors, and even management. And so we're going to now think about, in future lectures, how we are going to go about actually gathering evidence now that we've determined our planned level of detection risk.